that signal identifies FOMO transactions at the top. So every time there's a top, it flashes red. But when that signal flashes red, I will be very worried. So I can really not see it going below. So the stock to flow is quite interesting metric. My insight was, one step back. I missed a fundamental model in Bitcoin. And being an institutional investor, okay, the technical analysis is nice and certainly helpful, but you need to have a more fundamental model from first principles that, like the capital asset pricing model, we'll talk about it in a minute, I guess, with the equity risk premium. The capital asset pricing model says, okay, if an asset is more volatile, it should give you more return. And you cannot have a high return without that volatility, because then everybody would be a millionaire, right? So it's only the people that can stomach that volatility will be able to earn the high return. And we as Bitcoiners the volatility is so high. But the stock to flow model missed this. I missed this fundamental model, and that's where I, of course, read a lot about Bitcoin, the white paper, and then Savenin's book, a must read, of course, for every Bitcoiner. And the scarcity part of Bitcoin is what jumps out. That's what caught me and a lot of investors. There's only 21 million. They're even scarcer than gold, because even when the price goes up, normally when the price of a commodity goes up, the producers produce more of it, bringing the price down again. But with Bitcoin, you can't do that. So it's a very, very fundamental thing of Bitcoin that it has this built-in scarcity, the 21 million coins. My insight was the scarcer an asset, the higher the market value would be, because people value scarce assets higher than non-scarce assets. It's just everybody knows that. It's with watches, with art, with everything. So that's when my addition was to take the scarcity stock to flow ratio and then map that to the market value of several assets, and even dynamically through time. That was the stock flow model. And the stock to flow cross asset model then brought in the gold data and the silver data, real estate and diamonds. And then you see, like you would expect, that the scarcer the asset, so real estate is a scarcer asset, the higher its market value. And that's when I made this very rough. So it's a very rough model. It's a very simple model. It only has one input, and that is the scarcity stock to flow ratio. All the other factors, including demand, but all the macro news in China and bans and whatever. So there's like 100 factors that also impact the price. Those are not in the model. So the model is very simple. It's very rough. Yep. I think it's very intuitive and very directionally right. But demand is not in there. But demand is a very interesting variable, because that's very hard to measure, right? And Bitcoin is sort of a strange commodity asset. It's like a Veblen good, and in Veblen goods the laws of demand and supply don't work as you would expect. So because normally if a price goes up, if the price rises from of something, the supply of the demand goes down, and if the price goes down, the demand goes up. But with a Veblen good like Bitcoin or a Rolex watch or a piece of art, when the price goes up, demand goes up. It's the other way around, and that's because it's viewed as a luxury good, as a store of value. So demand is a function of supply. It's derived from supply. So I think that demand is a derivative of supply in the case of Bitcoin and other Veblen goods. The model has been far below the model prediction 3 times now since I wrote it in March 2019. So this is the 3rd time we're really below the model, but it was below the model value when I published the model. So we're basically at the same spot as 3 years ago. And we have been above the model like 2 or 3 times. And every time we're above the model, people say we're front-running the model. Oh, everybody knows it now. We're front-running, and it's a super cycle and blah, blah, blah. And when we're below the model, then everybody thinks the model is broken implicitly. But I know Metcalfe's law, of course, which is for companies that experience exponential growth, internet companies, Google and Amazon, etc., FANG group. Yeah, and all, of course, the new inventions, technological inventions, experiences this exponential growth. And you can see that in Bitcoin, right? When you see the graph on a log scale, it still grows. It's almost a straight line. And that's the signature of a exponentially growing asset. So it's there, but it's just an observation. So you can just put a line on there and say, well, it's exponential growth. But then you run into that extrapolation problem. How far will it grow exponentially? And when does it stop? So you can make logistic adoption functions, etc., but those are very dependent on their initial values and other assumptions. So of course, the big question is, when does it stop? And how long will Bitcoin grow exponentially? And we have grown from, below 1 cent to 40,000 right now. So it's amazing growth. And especially, I mean, for you as a tech investor as well, and I talk to a lot of tech investors, when you see it, it's almost impossible what Bitcoin did last 10 years. You know, something is going on there. That's coming back to the stock to flow X model and the real estate size of the market, about $100 trillion US dollars, hence my name, by the way. If we go beyond that, then it will be one of the larger assets in the world and certainly run into strange valuation things. And in fact, what we're also seeing, I guess, is not only the assets growing exponentially in the case of Bitcoin, but also stocks and real estate at the moment, is that the denominator, so the currency, the US dollar, is affected as well. All the money printing, the trillions and trillions of money printing, that seems to be having a direct effect on the valuations in that particular asset. And we have seen that maybe from a world view, if you look at countries like Zimbabwe, Venezuela, Turkey right now, all the countries that have run their currencies into the ground by printing it too much. In Venezuela, there's these nice pictures now of all the currency, all the notes on the roads, right? They throw them away. They're worth nothing. So what does it tell you? So in all those countries, the stock market went up exponentially before the currencies died. So we could also, and I'm always very careful to say it, but we could also witness the dying of the dollar right now because of all the money printing. It obviously, something broke. I guess every institutional investor knows that the US debt will never be paid back. And then, so we were talking about the on-chain signal of me, and I stopped twittering about it because that signal identifies FOMO transactions at the top. So every time there's a top, it flashes red because there are certain kinds of transactions. And think about, it could be transactions with a lot of inputs and a lot of outputs, or from certain addresses, or young addresses, or big, something like that. It's a combination that's proprietary, by the way, so I haven't published that. But when that signal flashes red, I will be very worried. And it didn't flash red yet. So that's why I believe, that's one of the reasons I believe.
Is it yellow?
Somewhere in the middle, which leads me to believe, together with the stock to flow model, of course, we're at the lower bands of the standard deviation, that the peak is not in yet. I sort of thought when it flashes red, when the peak is in, I will sell some Bitcoin. Not all of it, because I couldn't risk the super cycle going on and me not in there, but just a little bit to finance and fund the bear market that will probably come after that. But I was thinking, with an account that I have at the moment, if I tweet that just like any other tweet on a personal account, maybe some folks go berserk and go into full panic mode, and the market. I don't want to crash the market. I don't.
No.
So I thought it was better to not.
So you're saying it probably isn't the top based on what your indicators are and what you're looking at.
One thing I look at for bottoms is 200-week moving averages. And I think that's at around 19,000 at the moment. So Bitcoin has never gone monthly close, has never had a monthly close below the 200-week moving average. Yeah. But it's very, very low, right? So
that's like a short moment and it's going to bounce. Yeah,
exactly. That would be a perfect moment to buy. But if you make that into that number is heavily skewed by the lost Bitcoins and the first million Satoshi coins. So if you narrow the window down to, say, also 200 weeks or less, that number goes up significantly to in the 30,000-40,000 range. So I can really not see it going below 30,000.